Most families have no idea this tax rule exists until it's too late and could potentially save them thousands of dollars in capital gains taxes when selling a home in Texas. Today I want to talk about something called a step-up in basis. And I know it sounds super technical and honestly kind of boring, but if you own a home, have aging parents, or may inherit a property one day, this is something worth understanding. And before we jump in, I want to say I'm not a CPA or an estate attorney, so always talk with a tax professional about your specific situation. I just think this is one of those real estate topics more people should know about before they need it. So let's break this down in simple terms. Imagine a couple bought their home in Katy years ago for $185,000. Fast forward 25 years and now the home is worth $725,000. If they sold it while they were alive, there could potentially be a large capital gains tax bill based on the difference between what they paid for and what they sold it for. But here's where the step up in basis comes in. When someone passes away, the IRS may allow the value of the home to reset to the current market value at the date of death instead of the original purchase price. That reset is what people mean when they say step up basis. And because Texas is a community property state, married couples can sometimes receive a full step up in value when one spouse dies, not just half. That can make a huge difference in taxes later. Here's a simple example. Let's say a husband and wife bought a home for $185,000 years ago. One spouse passes away, and at that time the home was worth $725,000. If their surviving spouse later sells the home for $750,000, the taxable gain may only be based on the difference between $725,000 and $750,000, not the original $185,000 purchase price. That's a massive difference when calculating capital gains taxes here in Texas. Now here's the important part that many families miss: getting an appraisal around the time of death. A professional appraisal helps document the market value of the home at that specific time. Without it, years later, it can become much harder to prove what the property was worth at that time. And I've seen it many families who had no idea they should have done that. Now, let's talk about inherited homes and children. A lot of people ask me, does this work for kids inheriting a house from the parents as well? In many cases, yes. If children inherit a home after their parents pass away, they also typically receive a stepped up basis to the market value at the time of death. So let's say the parents bought the home for $90,000 decades ago, but when the children inherit it, it's worth $540,000. If the children turn around and sell it for $555,000, the taxable gain may only be based on that $15,000 difference instead of the entire increase from the original purchase price. Again, this can potentially save families thousands and thousands of dollars in capital gains taxes. Now, there are definitely exceptions and details that matter. How the property was titled, whether there was a trust involved, how long the heirs keep the property before selling, whether it was community property, and current tax laws at that time. So please, don't take this video as legal or tax advice. This is simply meant to help people know the conversation exists so they can ask the right professionals. Honestly, real estate is not just about buying and selling houses. Sometimes it's understanding the financial side of the home ownership and helping families avoid costly mistakes. If your parents have owned their home for a long time, or if you're helping a surviving spouse navigate what comes next, this is absolutely a conversation worth having with an estate attorney or a CPA. And if you found this video helpful, I would really appreciate it if you would like, subscribe, and share with someone who may need this information someday. You truly never know when one piece of information can save a family a lot of stress and money later.